you don't invest money for the sake of tax generally. However, and this is a horrible oversimplification, and so don't run to the bank or the CPA with this, but if your tax rate is 40% and you can eliminate 40%, but your return is only 4 instead of 12, well, guess what? That math works pretty fucking well. So there is rationalization for investing for the sake of taxation. You just have to be careful that you're not making a stupid investment just to defer. And there's a difference also between deferring tax and eliminating tax. Dig into the details of those things, but there's something to be said for that for sure. And a cost seg is an example, and I didn't really want to open the door of cost segregation. I know I've talked about it before on the show, but why don't you give your rough overview of cost segs on a commercial building or whatever, how they actually just however they play into your world.
So what is cost seg? Really, it's the ability to accelerate depreciation. So instead of, we buy let's say one of our shops, it takes 39 years on average to take that cost and, split it over 39, and every year we get a deduction. Cost seg, come in, pay a guy, whatever, $3,000, $5,000, whatever it costs. He gives us a report that says, hey, instead of spreading this cost over 39 years, we can front load and give you like a 70% of the building's expense on the first year. And then maybe you're only taking a smaller deduction on the next sequential, whatever, 10 years, 15 years, 39 years. So it's a way that you can front load the cost of a building instead of over time. The argument for it is like, hey, there's a time value of money, that $1 saved today is worth way more than $1 saved in 39 years, which it's especially with inflation. And so there are some number of different strategies depending on your tax brackets that you can use this. For us, without getting too complicated, one of the strategy we did last year was we bought a building. We were able to group that building to say it was a shop that we occupied, to group it into our existing business, and then that cost seg was able to come off our active income, and then we were to take like a $300,000 write-off on this building against our active income, because we occupied and because it was grouped. So without getting crazy into this, you can't always do this, but if it's a self rental, you got some more flexibility. So anyway, it basically saved us $300,000, on a $5,000 cost rather than, it's $300,000 but spread over 39 years. So. Yeah, okay, that's awesome. So I want to add a little bit of color and context. So the term cost seg is cost segregation, and the what you said kind of sounded like magic, and it kind of is magic, but it's the idea of just compress and accelerate depreciation. The logical reason for this is that study, that $3,000 to $5,000, is somebody coming in to assess what parts of the building rationally are going to depreciate faster than that, in your case, that 39 years that you mentioned, right? So how much of your building are you actually going to have to replace in 3 years, 5 years, 7 years? And then what percentage is that? And then that percentage, we can accelerate the depreciation onto 1 year, right? So there is some rationale behind how these things work. It's not totally magic. But the other cool thing about your model is that you have this built-in mechanism where you're in commercial buildings. So it makes sense for you to have all the commercial real estate behind it, or to look at that as a vehicle. And that's a pretty cool synergy between between investment strategy and depreciation strategy and reducing and tax strategy, and the core business itself, which is awesome. And whether your business has that or not, I suppose you can still look at a similar vehicle, right? You can still look at the commercial buildings, the commercial investments, but it's pretty cool that yours are intertwined like that too. Yep. And there's pros and cons. Once you spend it, you can't unspend it, right? So once we take all those losses, the next year we don't have it. So it's kind of this game of you gotta keep stacking them, potentially keep making these investments in cost seg, and otherwise you're gonna have some pretty big swings in the amount you owe. So there's some strategic planning around it, but I think if you're in growth mode and you're going to be buying assets that you can depreciate, whether they're business assets or real estate assets, they can go well together, and when you're in that growth stage to help you conserve cash.